Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I am going to go through 3 different companies that pay dividends, safe dividends, have been around for a very long time, has an absolutely very nice cash right now in hand, have increased that dividends for a very long time, and they have absolutely amazing balance sheet. So we're going to look at those 3 companies. But before we do that, there's a lot of things going on in the UK right now. Things seem a little bit gloomy. Every time I watch the news, I regret it. There's so much negativity going on, and there's so much reality as well. The energy prices are going up. People are genuinely suffering in a way, and things are not looking good. But inshallah, I think you're just going to have to keep an eye. Like I said in the recent video when we talked about the general markets and what's happening, okay, and how to actually survive in recessions. Just save as much as you can and take care of your families, because it seems a little bit gloomy out there right now. Okay, one of the things I want to quickly talk about is this, okay, and that Salesforce trims full year expectations for earnings and revenue. So they beat both earnings and revenue, but they said basically the expectations for the next couple of quarters or for the year is actually down a little bit because of the FX, basically the exchange rate situation going on. Because the dollar's going up, this company has a lot of companies they work with in Europe, and for that reason, okay, they are feeling it a little bit. And I like the fact that they've actually grew the business about their top revenue about 22%. Without the FX situation, it would have been about 26%. Now the expectation, although they trimmed it, right, they're expecting basically the revenue to grow at least to 18%, right? But because this company was expected to grow, I don't know, maybe 30% every single quarter or every single year, everyone just kind of thought, you know what, it's time to sell this company. So some people sold it. I'm keeping it, definitely. I'm not doing anything stupid because I'm a long-term investor. I'm going to keep it in there. It's a great business. To grow basically 18% is absolutely brilliant in this kind of situation. So I'm definitely going to keep that company. I'm not selling it at all. I'm just going to focus on what I need to do in the long run. Right, let's have a look at the 3 companies that we're talking about. The first company we're looking at today is Medtronic. Medtronic is one of the companies I own in my portfolio. Is company that has basically creates a lot of manufactures a lot of equipment, okay, healthcare equipment, currently trading $91 per share, EPS of $3.86. I have been talking about this company for a long time. If you watch my old videos, you will see I have been talking about Merck for a long time. I have been saying this company is undervalued. Right now is fairly valued, and at the time I was saying it and I was buying it at the same time. That's exactly what I'm doing with Medtronic right now. And I think some people will be probably sick of it, the fact that I'm actually talking about this company a lot, but there's a reason behind it, right? So next year they're expecting the earnings to grow, the EPS to grow $6, okay, up to $6 per share. Market cap of $122 billion. It has a wide economic mode and it has a very low beta. In terms of PE, we're looking about 24. 5-year average PE is about 35. This company has always been expensive, but price to free cash flow right now we're looking about 21.5, which is absolutely fine. Annual dividend yield. So right now I will say this company, based on their 5-year average, is actually all right. And look, based on the sector, 23 right now, 24, there's not much of a difference. So annual dividend yield of almost 3%, payout ratio on 67%, and 5-year growth rate, okay. In fact, this, let me double check this, because 67% seems a little bit too high for me. And one of the companies that I like to use, one of the software I like to use is Simply Safe Dividend, and as you can see here, it's only 47%, okay. So here we go. 5-year growth rate, we're looking about 8%, which is really nice. Dividend growth streak of 44 years. So they have increased that dividend for 44 years. And one of the reasons I've included in this video today is that safe dividend. And that safe dividend, okay, is safe because of almost this $6 billion in the bank. So this company has enough money in the bank right now. They are in the right industry, okay, and when it comes to basically healthcare equipment and so on. Profit margin of almost 16%, operating margins of 18%, return on equity of almost 10%, and total return with the last 10 years, Okay, including, by the way, when we say total return, we're talking about dividends as well as price appreciation. Okay, it's about almost 10.5%. Current ratio is about way above 1, which is very nice. So that means this company will be able to pay their debt in the next 12 months, right? This is one of the reasons why I'm still buying this company. Okay, right now they are expecting for the next 5 years 13% growth every single year in the next 5 years, which is absolutely huge for a pharmaceutical company. Simply Wall Street is actually saying their valuation is right now 23% undervalued. Their fair value is $120 per share. Morningstar is almost a 30% discount right now and 129. Tip ranks at 15%, and their 12 months price target is 106. And same thing more or less Yahoo Finance, but they are both saying it's actually kind of moderate buy. And I think if you own it already, I genuinely follow this a lot, even though I like to look at the other companies and get a feel. And when we talk about, by the way, and basically analyst predictions, these guys can make a mistake. That's absolutely fine. I mean, that's given, right? They're human. Sometimes they might overestimate and things like that, right? So that's why I like to give you a variety, just to kind of give you like 4 different companies that actually, or basically analysts that are looking at this and saying, you know what, this is where we think this company should be, either in the next 12 months or intrinsic value side of things. Okay, which is really basically one of the things that I look at when I'm basically invested in the companies. And the one that I actually use the most is Morningstar valuations, because of, as I said so many times, is the one company that I actually think is basically kind of very conservative when it comes to their valuations, right? Sometimes obviously they're human, they can make mistakes, but so far they have been all right. Okay, whereas simply Wall Street sometimes overestimated some of the companies, their prices and so on. So that's that company. And then the final thing I want to share with you is the shares outstanding right now. As you can see, it is basically stayed the same. They're not buying back any shares, so it had stayed the same in the last 4 years at least. Okay, so at least that's a good news. They're not buying it back, and they're not really diluting your shares. Okay, final thing I want to say about this company is when it comes to Sharia compliance side of things, and that should say 99%, not whatever you said initially, right? So as you can see, it's definitely Sharia compliant, and right now seems really undervalued. It's one of the stocks in my portfolio that I've been adding to in the last few months. So the next company we're looking at is Visa. Visa is, before I actually say anything, Visa does not deal with the riba side of things. They just transaction processing network company. So they provide the card, they provide the transactions, and then they let these companies do whatever they want to do. Same goes for MasterCard, because a lot of you have asked me recently, how are they Sharia compliant, right? They currently trading $205 per share, EPS of $6.5, expected about next year about 8.5 almost, and market cap of $442 billion. It has a wide economic mode, okay, and it has beta that's quite low in terms of, if you look at the technology sector, that's actually quite low. And right now PE is about 32. 5-year average is for the PE is also 32, and price to free cash flow is also 32. That tells me the company is possibly fairly valued at the moment. And when you look at the technology sector, we're looking at about 27. Visa, if you look at my old videos, you will realize at one point it was 40 plus when it comes to PE. So it has come down quite a bit. Annual dividend yield just below 1%, payout ratio 21%, 5-year growth rate of 15%, dividend growth streak of 14 years in a row, and dividend safety 99%. They have $16 billion in the bank. They can use that money for all sorts of things, including buying back shares, paying you dividend, paying off debt, buying other companies, okay, reinvesting in the company, whatever they want to do. Profit margin is absolutely amazing, 50%, operating margin 64%, return on equity you're looking about 42%, total returns in the last 10 years you're looking about 21%, which is absolutely huge, and their current ratio is above 1, which is really nice. In terms of 5-year growth, we're looking about 18%. That's absolutely amazing. And according to Simply Wall Street, 26% undervalued right now. Their fair value price is $282 per share. Morningstar has more or less the same, $229 per share, okay, fairly valued at the moment. So you can see here the difference between 229 and 282. So they a little bit think is quite undervalued at the moment, but again, it's when these companies do these things, they're using intrinsic, basically the intrinsic value or side of things, and what that means, they do discounted cash flow model, and it depends what they include and their estimations. These things are estimates, they're not actual, okay? No one knows what's going to happen in the future, so they use some sort of estimation by using discounted cash flow model, okay? So that's why you have to think about it. So sometimes I might present a video and say, okay, this company is undervalued at the moment or cheap, whatever, and some of you will jump straight, how can you tell? Right, just relax. It depends on the fair value, or depends on the discounted cash flow model the person used and what's actually included in that price. Okay, what's included in that formula. Okay, so that's sometimes what happens. So just to think about that before you say anything else. Tip rank is right now saying 23%. Okay, price target, we're looking at about 256, and according to Yahoo Finance, 261. So these two are kind of very similar if you think about it. Okay, but everyone is saying basically is undervalued at the moment or fairly valued. Strong buy right now. So if you look at Morningstar, 229 and currently trading $206 per share. So it's definitely undervalued according to them, and it's a strong buy according to tip ranks. Now, shares outstanding, they definitely have been buying their shares in the last 10 years, which is absolutely amazing to see, because that's nice for us as investors. And as you can see, their business activity is 100% compliant. Interest-bearing debt is only 5%. Interest-bearing securities is only 5% as well. So they are definitely Sharia compliant, but again, you need to do your research and find out a bit more information as always. The final company we're going to talk about today is UNP, or Union Pacific. This is railroad company. I own it in my portfolio. Excellent company. Been around for a long time. It's an industrial company. As you can see, $235 per share. EPS right now looking about over $10, and next year it will be over $12. Market cap of $149 billion. Economic mode right now is wide economic mode, and beta is slightly above the market. Slightly what we're looking for. So normally we're comparing this with the S&P 500, okay, so the actual market. So the indexes basically, if it's basically above one, then that means it's more volatile than the actual index. But right now it's slightly higher when it comes to that. Evaluation measures in terms of PE, we're looking about 22. In terms of 5-year average PE, we're looking about 20, and price to free cash flow looking about 26. And the sector right now, okay, the industrial sector is about 22 right now. They have a nice dividend, so 2.18% payout ratio of 44%, and then 14% 5-year growth rate, which is really good for a company that has been around for a long time. In terms of dividend streaks of 23 years right now, 2 more years and they will become dividend aristocrat. That's a company that has paid or increased their dividends for 25 years or more. Dividend kings are companies that have increased their dividend 50 years or more. In terms of safety, we're looking at about 88%. That's one of the reasons I've included in here today, and $5.58 billion in the bank of cash basically. And like I said, they can do a lot of things with that cash right now. Profit margin, we're looking at about 29%. Operating margins 41%, return on equity 52%, and total return in the last 10 years over 15%, which is really nice. In terms of the next 12 months current ratio, so current liabilities is actually higher than the current ratio. For that reason is 0.70, but I wouldn't worry about this company. Company has a lot of cash in there, and they can raise money if they need to as well. Okay, they might have to take a little bit more debt, but then that's fine for some companies. Okay, 5 years growth, 5 year the expectation for the next 5 years in terms of earnings is about 15%, which is absolutely huge. And simply Wall Street is saying right now about 15% undervalued. Fair value $279 per share. Morningstar 17% discounted. Fair value of $321 per share. So as you can see right now, Simply Wall Street is actually basically a little bit more bearish when it comes to this company and in comparison to Morningstar. And Tibrax is actually saying fairly valued at the moment. It looks like 238, and according to Yahoo Finance, 241. And as you've seen before, 235 is the current price, and is a moderate buy. right now according to tip ranks, and as you can see, they have been buying back their shares in the last 10 years, which is absolutely amazing. Right now, UNP or Union Pacific is actually 99.98% in terms of the Sharia compliance side of things. Interest-bearing debt is 25%, so let's hope it doesn't increase. But if it starts going up again, that's a little bit worrying, because 8% more, then it will be probably heading towards not compliant. But in terms of interest-bearing securities, 0.6. That's what we're looking at right now. That is 3 stocks that I want to share with you guys, just to be transparent. I own Medtronic there. Okay, I have 26.8 shares of that company. I own Union Pacific here, 12%. or 12 shares, sorry. And finally, I own Visa, okay, 10 shares of Visa. So I own all 3 companies in my portfolio. So yeah, the portfolio is still doing all right. I mean, it went down quite a bit today because the general market is down, but that's normal. Some days up, some days we're down. Like I've always said to you guys, I'm going to keep buying. In fact, I've actually added today £250. I haven't bought anything yet. So I've got a couple of companies in my eyes right now I'm looking at. So inshallah, I will be adding. I'm not buying anything new yet. Okay, although there's one company that I'm going to trim. I'm going to use that money for another company. But right now, this money will be going towards one of the existing companies that I have in my portfolio. As always, I've been sharing this portfolio every single week. If you like this kind of content and you appreciate the transparency, please like the video, subscribe to the channel. Let me know if you have any questions. Enjoy your Friday. Assalamu Alaikum.